Friends, the WACC, weighted average cost of capital, is an extremely important number in the domain of finance. Any decision that we take in finance, whether for the capital expenditure, whether for organic growth or inorganic growth, for taking over a company, for buying a company, for making new investment, for any decision, for making investment into the share market, in derivatives, in currency management, everywhere, this weighted average cost of capital is very, very important. Let me explain it to you with the help of an example using an Excel sheet. So using an Excel sheet, and this is where I'm going to bring it. So let's say here, how do we calculate the weighted average cost of capital? So remember, in our business, there are broadly two sources of capital. One is equity. Are you able to see my screen on your screen, please, everyone?
Yes, sir.
Okay, very good. So one is equity and second is debt. Now let's say in my business, equity is 1000 and debt is 2000. Now debt, remember, whenever you borrow money, it will always come with a given rate of interest. So let's say the rate of interest in case of this debt is 10%, and which is net of tax. Okay, so let's say net of tax, the rate of interest is 10%. Now, which means I will write it as 0.10. Then equity. How do I find out the cost of equity? And that is a very big challenge. And why that is a very big challenge? That is a very big challenge because in case of debt, you pay interest. So you can divide interest by the amount of loan and you can arrive at the rate of interest, or rate of interest is always given to you. Like in this case, we have taken it as 10%. In case of equity, there is no such fixed rate of cost of equity. And why there is no fixed rate for the cost of equity? Because on equity, as we have discussed some time back as well, it is not necessary that you have to pay dividend. Because if a company does not make profit, company does not pay dividend. Company makes profit, company can still decide not to pay dividend. Company makes profit, can decide to pay dividend only 10%, 20%, 30%, 40% of the profit. And therefore, to decide the cost of equity becomes a challenge. But there are lots of models available for determining the cost of equity. You can use any of those models. One model which is commonly used all over the world is known as CAPM, Capital Asset Pricing Model. So you can use CAPM. It is used extensively across the globe. But in the simplest words, what is cost of capital? Cost of equity. Cost of equity is nothing but the expectations of the shareholders. So you are putting your money into a business as an investor. You have an expectation and to earn at least so much of return on that investment. And your expectation, remember, becomes the cost of equity. So let's say, for example, that cost of equity is 15%, right? So if you put your money into a business, so let's say in our group, when we make an investment, we expect that we should be able to earn a return of 15%. So that is the cost of equity. So what we have, this is our capital structure, and this is our capital, and this is our cost of capital of each source. So how much is the cost that we are going to incur? The cost is going to be, number one here, it is going to be 15% of 1000. That means my cost of equity in terms of money is 150 euros. What is my cost of debt? My cost of debt is 200. What is my total capital? My total capital is 3000. So 3000 is my total capital in my business. on this capital of 3000 which I have in my business, I am incurring a cost of €350. So which means, what is my WACC? What is my WACC? What is my weighted average cost of capital? My weighted average cost of capital is 350, the cost that I am incurring, divided the capital that I have into 100. And so my cost of capital, my weighted average cost of capital is 11.7% or 67%. So friends, this is how you will calculate the WACC, weighted average cost of capital. This is how you will calculate the weighted average cost of capital. In case if you have any question, please ask me, and then we will move to the next discussion.